From downtown Milwaukee, welcome to Money Talk with Bob Landaas. Each week, professional advisors from Landaas & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for Friday, January 2nd, 2026. Let's see what's happening. In West Dallas, the U.S. Olympic team trials take place through Monday at the Pettit National Ice Center. They're competing for spots in the 2026 Winter Games. You can still check out the Christmas decorations at the Pabst Mansion through Sunday. And if you didn't get enough holiday lights, there's a drive-through light show at Brown Deer Park on Saturday night. Drive-through part is right up my alley. The Bucks host the Hornets at Fiserv tonight, and the Packers are in Minnesota with the Vikings on Sunday. As if we already didn't know this, it's good to be Beyonce. According to Forbes magazine, she joined an exclusive club of singing billionaires. Also in the club, her husband Jay-Z, and rounding out the top six are Paul McCartney, Taylor Swift, Rihanna, and the boss, Bruce Springsteen. I'm going to have Bruce in my ear all day. United Site Services, which owns 350,000 porta potties, filed for bankruptcy on Monday. They plan to restructure to the tune of $2.4 billion. Does that include TP? And finally, a deaf woman was out walking her dog in a park in Long Beach, California, when she was struck by an airplane trying to make an emergency landing. Again, she's out walking her dog, and she gets hit by an airplane. What are the odds? She ends up in the hospital, and the doctor says she's going to make a full recovery. I never give financial advice on this program, but she should buy lottery tickets. On the podcast today, we have Kendall, Bauer, John Sandstrom, Joel Driesing, and wrapping up the week, here's Kyle Tetting.
Yeah, thanks, Max. More wrapping up the year. It was a stellar year, 2025, for markets, and not just stock markets, but as we look more broadly at the economic landscape, as we look at fixed income, so many places to point to that were reasonably positive. I'll start just by saying the S&P 500 up 17.88% last year, including dividends. It's really hard to overstate just how strong of a run it's been the last 3 years, the last 5 years. Looking back over the last three alone, 23% returns a year on the S&P. And so I think investors looking at their portfolios have probably seen a pretty immense shift, if they did nothing else, a pretty immense shift towards the stock piece of their portfolio. And so first and foremost, perhaps 2025, the year in which rebalancing probably was the place to be thinking. But if you look more broadly, even at some of the quieter areas of the market, like the aggregate bond index from Bloomberg up 7.3%, you look internationally, very strong returns, looking at the ACWI US up 24 in local terms, and in dollars up 32.33%, simply because of the impact of that currency exchange. And so an immense year for returns virtually across the board. And with that, thought it would be a good opportunity to kind of revisit some of what drove those returns, some of the positives. Tough to point to too many negatives, but certainly I think some things that were concerning as far as developments in 2025. Less about maybe what they mean for us going forward. We talked about that last week, and certainly we'll talk about that in the new year, and more about just a good opportunity to point to here's all the things that have come. And John, I guess I'd be remiss if I didn't maybe start with one of the things we don't normally talk about, which is the rally we saw in some risk assets that maybe we don't normally put in the conversation, things like precious metals, gold and silver, some of the best years we've seen in a very long time. What kinds of things are you talking to clients about? What kinds of things are you seeing as we look at kind of that corner of the world?
Yeah, so gold has had its best year since, I think, 1979 when I looked, up over 60% year to date. And I have had clients ask, hey, what are we doing here? Why don't we have a piece of our portfolio in gold? And I guess the answer to that, in at least this year, is it's been a perfect storm for gold specifically. And it actually relates to a lot of the other things that drove a lot of different markets this year. Things that benefit gold or tend to see gold increase, geopolitical instability, which we have plenty of. Dovish monetary policy, so lowering interest rates also drives gold up. You see weakening U.S. dollar. The gold is priced in U.S. dollars. It allows non-U.S. Currencies to buy more of it. It makes it cheaper. We've also had record-breaking central banks around the globe in buying gold. And then, like Joel will probably talk about later, there still are fears of inflation, and gold is a hedge to that.
And so I think worth pointing out that we do occasionally get some meaningful spikes. When you get that perfect storm, it doesn't mean necessarily that that perfect storm persists. Maybe it does for a little while, maybe it doesn't. But a strong reminder that when you look over the history of those types of investments, yeah, you'd probably much rather own the stock market than you would precious metals. You'd probably much rather participate in the profitability of this country and the businesses that make it up than simply hope that you can keep pace with inflation beyond just a few days, because the reality is businesses are really well positioned not only to keep up with inflation, but actually to outpace it as long as they continue to innovate, as long as they continue to change. And Kendall, maybe that's one area that 2025 really brought a lot of potential from, was this massive build out of the infrastructure around artificial intelligence. You know, the hope that maybe some of that productivity gain in the future will drive future profitability, but certainly it drove very strong returns for stocks in 2025.
I think you could toss in strong economic growth as well. I mean, we've seen record CapEx spending from a lot of these big tech companies in the past couple of years, and every indication on, the fact that they're going to continue to do so moving forward. I think you could say the AI, expansion and all the spending and optimism is arguably what was one of the biggest drivers of growth this year, in the markets and economically. I think, double check me on this, that it even outpaced consumer spending as far as growth contributing to GDP.
No, I think those are all really strong points, and worth, I think, really stressing that 2025 was a year in which investors did so much better than those that weren't willing to step into that fray. We talked at the seminar going back to 2024 about the role that cash played, and that was a really easy conversation then, in part because money market yields were north of 4%, in part because we entered a new year, 2025, looking back, again to the fall of 24, with some potential uncertainty over an election, some potential uncertainty over any number of geopolitical risks that were out there. And yet when you look at some of the maybe first steps into risk this year, instead of holding cash, maybe I buy bonds. Instead of holding cash, maybe I buy something else that's viewed somewhat as a safe alternative to just buying stocks. While even the fixed income markets were up 6.5%, 7%, it's a far better story than it was for, just leave it in cash and hold it there. And a reminder then in our 2025 seminar that as we see interest rates come down, it's going to be even more difficult for investors to have cash participate in that conversation when we're seeing the benefits of the tailwind of falling rates to fixed income, and more importantly, when we are seeing yields on a lot of these bond funds that on their own outpace cash, add in that tailwind, and all of a sudden it looks more attractive. And one of the things, Joel, that maybe supported that was some changing winds on the economic front in 2025.
We had a couple of developments. One was that the inflation rate, which is something of very persevering concern among a lot of consumers, has been stubbornly high. It's been over the Fed target of 2% now for more than 5 years. It's a little lower now than it was at the beginning of 2025, but it's still above that 2% mark. And we still don't know what the effects of the tariff changes are going to be on inflation in the long run. We expected more results in the short run, and we didn't see them. So there are economists who are saying, well, it's just been delayed. We're going to see more of those effects later on, and it's going to affect inflation. But there are other economists who say maybe not. The other thing is that we know that the economy is getting old as far as its growth cycle. we're starting to have a weaker job market. The latest unemployment rate was 4.6%, which historically is still pretty reasonable, but it's up from 4% at the beginning of 2025. It's the highest rate it's been in 5 years, and there are signs that it's not going to get any stronger, that there's a weakness there. And you wrote an article for our website, and it's in our newsletter that goes out today, looking at some of the factors in some of this stuff, and things like the tariff announcements. Not quite sure yet how that's all going to play out. Also looking at things like deportations and immigration policies, and what factor that has on the labor market, and what factor that has on the economy as a whole. Otherwise, though, the economy still seems to be humming along. We talked about consumers being concerned about inflation, and we've discussed this before on the podcast, but there's a disconnect between consumers being concerned about inflation and they're still buying things, and that's keeping the economy going.
And I think that's fair, and I think some of what has driven that is, you mentioned an aging economy. Not only is it aging in terms of the current cycle, but we did have 4.5 million people turn 65 this year, and at least based on the current demographics, that probably is the biggest transition point we're going to see. And now it starts to slow down. The overall demographics of our country don't age quite as quickly from this point on. I mean, yeah, we all age 1 year at a time, I guess, but certainly the biggest impact on kind of that peak 65 is past us now. And so it does speak, I think, to some of the stability we've seen economically, and that the closer you get to kind of those retirement years, the easier it is to at least know, okay, well, my spending is going to be taken care of. It might be a little more, it might be a little less, but I know where it's going to come from. Social Security, my pension, if I was lucky enough to have one, and the savings that I was able to accumulate while I was working. And so I think some of that stability, and we've talked about this a few different times in the past, comes simply from the fact that older consumers tend not to be as variable because they know precisely where the money's going to come from. They're not impacted as much by the labor market. And so I think that's been a big part of what we see as well. You know, John, maybe one other thing worth pointing out is just how strong of a year it has been for foreign stocks. And certainly a big part of that, well, maybe in part, came from better valuations. Here in the U.S., the S&P 500 finished the year around 23 times forward earnings, while overseas it was a far better number to start the year and remains a far better number. But also the currency piece, I wonder what you saw globally. I wonder what you're kind of looking at, and especially kind of maybe how that sets up as we look ahead.
Yeah, and we've actually talked about this on the podcast plenty, but the tariff conversation did have a big piece in global trade and reshaping how that looks, especially in Europe. There's also quite a few other policy decisions that have maybe sparked extra spending in business in Europe, especially. But as you said, I think from a fundamental standpoint, the numbers in plenty of different markets globally just look, a little bit more attractive in certain scenarios, especially Europe. And, you pointed out the PE numbers are still much more attractive than a lot of the U.S.
I look at things like the stimulus spending that Germany has approved now, and so much of that will be geared towards defense spending, likely, as NATO's committed to these massive amounts of spend. Well, okay, sure, somebody like Boeing or a U.S. defense contractor may benefit a little bit from that, but it's worth pointing out that Europe has infrastructure as well, and in many cases, infrastructure that is far better suited for what the European defense and European defense plan actually needs. And so I think there is some sense that a good bit of this year's return came simply from some of that stuff you were talking about, right? The trade war certainly weighed, but also some of the moving or the shifting winds have helped immensely in kind of driving those foreign returns. And again, coming at a time in which, well, there's questions about trade here, there's questions about our own internal policies. Maybe we can insulate ourselves. Europe's certainly trying to do that. And again, I think that's a big part of what drove foreign returns. Kendall, no shortage of challenges from the year, one of the ones that really stood out to me is just the continued kind of gamification of the financial markets in one way, but in another way, how much of what we once considered to be a very different universe that investing has kind of now wrapped its claws around the investing moniker and turning itself into something that maybe it shouldn't be. I'm speaking specifically of some of the cryptocurrency things, some of the prediction markets that are out there. What kinds of things did we see in 2025, and what does it mean for investors?
I think 2025 certainly was the year for prediction markets, which, you could argue is a fancy reframing of online gambling, just based on real world events, anything from who's going to win the election to whether or not Taylor Swift is going to show up at the next Chief game. And it's been fascinating to follow. We've seen billions pour into these things. A lot of the demographic is geared towards younger individuals, younger investors, younger adults, and something just to be mindful of. I think you fall susceptible to opening up a Robinhood account if you're young and trading stocks, and all of a sudden you see another tool in there, for example, of, hey, why don't you place a bet on this or that? And it starts to blur the line between not only trading stocks, but investing and gambling. Not to mention that there's still some gray areas from a regulatory standpoint. So prediction markets, they gained a little bit of stability on grounds, getting some, I think, federal regulatory oversight approved this year. But from a state standpoint, state laws individually, state taxes, gambling classifications, some of these states are pushing back pretty hard. I don't think it'd be shocking to see Nevada as one of those. But again, more or less, I think just an important reminder to kind of proceed with caution for younger investors. Understand that you can relabel online gambling or sports betting to a different name, and it doesn't necessarily mean it's safer or something that you need to be participating in with regard to your investment.
And Kendall, that concern that you have for younger investors, I just wanted to note that was one of the developments we've had as a firm in the last year, is that you've started writing a series of articles aimed at young investors. The latest one is actually about how important it is for investors, really of any age, to know themselves and to make sure that the plans that they're making are for them and for their own individual needs.
Yeah, I think it is so critical that when we find those concerns, that as often an authority on investing, on finance, on those types of topics, that we need to get a voice out there that people can point to. And so it's why I'm so encouraged, Kendall, by what you've put out there. As importantly, a big thing that we saw in 2025 was this, I think, continued emergence of online scams. Now with participation from artificial intelligence, it's just so much easier to make these convincing schemes and scams and frauds, and no shortage of those this year. And so Joel and Jason Skuglik and any number of other individuals here have spent considerable time kind of putting pen to paper on ways we can help, but also in working through with individual clients, what can we do? And so certainly I think that has been of some of the biggest maybe negatives to 2025. That's the one that maybe weighs most heavily on me, is just how much work still needs to be done to help protect people from what's out there. And so can't stress enough that talking about those things is where it begins, that if you see something, if you are witnessing something, if you are concerned about a friend, a family member, a neighbor, that you're going out of your way to check on those kinds of scenarios, because it is just becoming far too easy. It used to be that these scammers preyed on the weakest link. They found the people that were most likely to fall victim, and they went and took their money. And now they're not just going after the weakest link; they're going after often the best and brightest, because they know there's sometimes more to be had there. And so the juice is worth the squeeze, as it were. And so I think as we kind of think through what do we need to do to help steel ourselves looking into the new year, well, that's certainly one of the areas that we're going to spend considerable time and energy. With that, we enjoyed doing the program for you. So appreciative that you've been with us for all of 2025 and wish you a happy, healthy, and prosperous 2026.
Thank you for listening to Money Talk with Bob Landaas. If you have a financial question you want answered on next week's show, email it to moneytalk@landaas.com. To keep informed throughout the week, visit our Money Talk page at landaas.com.